For decades, Americans were told a comforting story that as long as the United States remained strong, innovative, and productive, debt didn't really matter, that the dollar's dominance made America immune to the rules that applied to everyone else, that deficits were a future problem, not a present one. But today, quietly and without ceremony, the United States crossed a line that history treats very differently. America's national debt is now equal to 100% of its entire economy. Not projected, not hypothetical, already done. And when countries reach this level, something always changes, not overnight, not with a dramatic collapse, but through pressure, slow, compounding, unavoidable pressure, the kind that reshapes markets, governments, and everyday life. Now, before we go any further, let's be clear about one thing. This video is not about panic. It's not about predicting the end of America tomorrow. It's definitely not about fear-mongering. It's about understanding what breaks first when a system reaches its limits. Because history doesn't punish countries for having debt. It punishes them for ignoring what debt eventually does. Debt to GDP is not just an abstract economic ratio. It's a measure of flexibility. It tells us how much room a country has left to respond to crises, recessions, wars, and shocks. At low levels, debt buys time. At moderate levels, debt buys growth. But at extreme levels, debt removes choices. And 100% is where those choices begin to disappear. Every dollar the economy produces is now matched by a dollar already owed. Every future decision becomes constrained by promises made in the past. This is the moment when governments stop asking, what's the best policy? And start asking, what's the least painful option? History has seen this moment before, not in failing states, not in weak economies, but in advanced, respected, powerful nations that believed they were different. They all said the same thing. Our situation is unique. Our currency is special. Our economy can handle it. And every time, the math answered back. So the real question isn't whether the United States can survive 100% debt to GDP. It can. The real question is far more uncomfortable. What breaks first when it does? Is it the federal budget, the bond market, the dollar's global dominance, or something closer to home, like purchasing power, housing, or retirement security? That's what we're going to unpack. And by the end of this video, you can all understand why this threshold changes the rules, even if most people don't feel it yet. To understand why this moment matters, we need to rewind slightly. Because 100% debt to GDP didn't appear overnight. It wasn't caused by a single crisis, a single president, or a single policy mistake. It was built slowly, decision by decision, year by year, often with good intentions. Wars were financed, recessions were softened, pandemics were survived, markets were stabilized. Each time, debt was presented as a temporary solution. And each time it worked, until it didn't. The danger of debt is not that it fails immediately. The danger is that it works so well for so long that governments forget the cost. Debt delays pain, but it never removes it. When debt levels are low, governments can stimulate growth without consequence. When debt levels are moderate, borrowing still feels manageable. But when debt reaches the size of the economy itself, the relationship flips. The system stops serving the economy. The economy starts serving the system. At this stage, growth no longer reduces the burden. It barely keeps it from accelerating. And that's where the United States is now. Here's the part most people miss. The problem is not the total amount of debt. The problem is how sensitive the entire system becomes to small changes. When debt is this high, tiny shifts in interest rates create massive effects. A 1% increase in borrowing costs doesn't sound dramatic, but at this scale, it translates into hundreds of billions of dollars in additional annual expenses, not one-time costs, permanent ones. That money doesn't create new roads. It doesn't fund new technology. It doesn't strengthen the workforce. It simply services the past. And this is where the first cracks begin to form. Because governments don't have unlimited revenue. Every dollar spent on interest is a dollar that cannot be spent elsewhere. Social programs feel the squeeze. Infrastructure gets delayed. Defense budgets face pressure. Political fights intensify, not because leaders suddenly become irresponsible, but because math starts enforcing discipline where politics failed. This is why countries at this stage don't collapse suddenly. They grind. Progress slows. Promises shrink. Expectations are quietly revised downward. And while markets may not panic at first, they do notice one thing very clearly. Flexibility is gone. When the next crisis arrives, and it always does, the question won't be, how do we respond? It will be, what can we afford to sacrifice? And that brings us to the first thing that historically breaks under this weight. Not households, not stocks, but the government's own balance sheet, specifically interest payments. That's where the pressure becomes impossible to hide. And that's where the story turns from abstract numbers into very real consequences. When debt reaches the size of the entire economy, the first thing that breaks is not confidence, it's cash flow. Specifically, the government's ability to service its own debt without distorting everything else. Interest payments are the silent killer of highly indebted nations. They don't grab headlines like stock crashes. They don't create dramatic panic, but they quietly absorb resources until nothing else can breathe. For the United States, interest on the national debt has become one of the fastest growing expenses in the federal budget. Not Social Security, not healthcare, not defense. Interest. And unlike those categories, interest payments buy nothing. They don't improve productivity. They don't create jobs. They don't strengthen the economy. They simply keep the system running in place. Here's where scale matters. At low debt levels, interest is manageable. At moderate levels, it's noticeable. But at 100% debt to GDP, interest becomes dominant. Even small increases in rates translate into enormous costs. A 0.5% change can add tens of billions of dollars annually. A full percent can add hundreds of billions. And once those payments are locked in, they don't go away. This is where the trap tightens. Because governments don't control interest rates alone, markets do. If investors begin to demand higher yields to compensate for a risk, the cost of debt rises automatically. No vote required, no legislation needed. It happens through auctions, expectations, and confidence. And when confidence wobbles, borrowing becomes more expensive, fast. This forces governments into impossible trade-offs. Cut spending to pay interest, raise taxes in a slowing economy, borrow even more just to service existing debt. None of these options lead to growth. They lead to stagnation. This is why countries at this stage don't usually default outright. They choose something subtler. They stretch timelines, they roll over debt, they refinance endlessly. The system survives, but at a cost. That cost shows up as underfunded infrastructure, delayed reforms, lower long-term growth, and eventually public frustration. People don't feel this as a single moment of collapse. They feel it as a slow erosion. Opportunities become harder to reach. Wages struggle to keep up. Public services degrade quietly, all while the government insists everything is under control. And to be fair, in the short term it is. But markets are forward-looking. And once investors realize that interest payments are starting to crowd out everything else, their attention shifts to the next pressure point. Not Washington, not politics, the bond market itself. Because when debt becomes this large, the bond market stops being a funding tool and starts becoming a judge. That's where the real discipline begins. And that's exactly where we're going next. Most people think governments control their own destiny. In reality, once debt reaches extreme levels, that control quietly shifts to the bond market. Because the bond market is where promises are tested. Every time the US government needs money, it doesn't print it directly, it borrows it through treasury bills, notes, and long-term bonds, and each one is an auction. Investors look at the numbers, the trajectory, the politics, and the risks, then decide one thing: how much do I need to be paid to lend to this system? As long as confidence holds, borrowing remains cheap. Yields stay manageable. The system breathes. But at 100% debt to GDP, confidence becomes fragile. Not broken, fragile. Because investors are no longer evaluating growth potential. They're evaluating sustainability. And there's a critical shift that happens here. The bond market stops asking, can the US grow? And starts asking, can the US keep rolling this debt forever? That's a very different question. When doubts creep in, investors don't panic immediately. They ask for compensation, higher yields. At first it looks harmless, a few basis points, a slightly weaker auction. But those small moves compound. Higher yields mean higher interest payments. Higher interest payments worsen deficits. Worsening deficits require more borrowing, which leads to more bonds, and more bonds require more buyers. This is the feedback loop that traps highly indebted nations. It's not dramatic, it's mechanical. And the longer it runs, the harder it becomes to stop. This is why long-term yields matter more than headlines. The 10-year, the 30-year. They represent trust over time. When those yields rise sharply, they're signaling something simple. Risk is increasing. And when that signal appears, it spreads. Mortgage rates rise, corporate borrowing costs increase, state and local budgets tighten. Suddenly, debt is no longer a federal issue. It becomes a national one. Households feel it through higher housing costs. Businesses feel it through tighter credit. Markets feel it through repricing. And yet, even at this stage, the system still doesn't collapse. It adapts. Central banks step in. Liquidity is provided. Narratives are managed. But each intervention comes with a cost. And eventually, the bond market forces the next question. If debt keeps growing, and yields keep rising, what happens to the one thing holding it all together? The dollar. That's where the story becomes global, and that's where the stakes rise far beyond Washington. For decades, the United States has relied on one extraordinary advantage: the dollar, not just as a currency, but as the world's financial backbone. Global trade is priced in dollars, energy is settled in dollars. Debt contracts, reserves, and balance sheets across the world depend on it. This has allowed the US to do something no other country can: borrow in its own currency, at scale, for decades. As long as the dollar remains dominant, demand for US debt never truly disappears. Foreign governments need treasuries. Banks need them. Institutions need them. This is why many believe America's debt doesn't matter, because the world has no alternative. But here's the part that's often misunderstood. Reserve currency status is not permanent. It's conditional. It depends on trust, stability, and long-term discipline. The dollar doesn't collapse suddenly. It weakens gradually through diversification, hedging, and quiet shifts. Central banks don't announce exits. They adjust allocations. They buy a little less. They hold a little more gold. They explore settlement outside the dollar. Individually, these moves look insignificant. Collectively, they matter. At high debt levels, the U.S. becomes more dependent on continued global demand, not less. That's the paradox. And when debt to GDP hits 100%, that dependency becomes structural. Any meaningful loss of confidence, even marginal, enforces difficult choices. Higher yields to attract buyers, more intervention to stabilize markets, or policies that quietly erode purchasing power. This is why inflation becomes tempting. Not because governments want to destroy currency, but because inflation reduces the real value of debt. It's the least visible option, the most politically survivable one. But inflation has consequences. It punishes savers. It distorts prices. It transfers wealth quietly. And over time, it encourages even more diversification away from the currency creating it. This is the feedback loop few want to talk about. The more debt grows, the more pressure there is to manage it invisibly. The more invisibly it's managed, the more trust slowly erodes. Again, not collapse, drift. And drift is far more dangerous because it goes unnoticed. By the time people feel it, the process is already advanced. Which brings us to the most uncomfortable part of this story. Because when debt, bonds, and currency options all narrow, governments are left with no good choices, only trade-offs. And that's where the real cost finally lands. Not on markets, but on people. When nations reach this level of debt, the hardest truth is this. There are no painless solutions left. Every path forward comes with a cost. And that cost doesn't stay in Washington. It flows outward. Let's look at the 4 options. Governments always face at this stage, cut spending. On paper, it sounds responsible. In reality, it's explosive. Cutting spending means fewer services, delayed infrastructure, and reduced support, often during periods when people need it most. It slows growth, it increases public anger, and politically, it rarely lasts. Next option, raise taxes. Again, logical in theory. But at high debt levels, higher taxes tend to suppress economic activity. Businesses invest less, consumers spend less, growth slows, which means the debt problem doesn't improve, it just becomes heavier. Then there's default. This is the option everyone pretends isn't real. For the United States, outright default would be catastrophic. It would shatter trust in treasuries, destabilize global markets, and permanently damage credibility, so policymakers avoid even speaking its name. Which leaves the 4th option, the one no one votes on. Inflation. Inflation doesn't require legislation, it doesn't require public approval, and it doesn't show up as a line item on a bill. Instead, it quietly reduces the real value of debt, but it also quietly reduces the real value of wages, savings, and fixed incomes. This is why inflation often becomes the path of least resistance, not because it's harmless, but because it's gradual, and gradual pain is easier to manage than sudden shock. This is where everyday Americans start to feel the weight of high debt. Housing becomes less affordable, borrowing becomes more expensive, savings don't stretch as far, people feel like they're working harder, but getting less ahead. And yet, nothing looks broken. That's what makes this stage so dangerous. There's no single crisis moment, no dramatic collapse, just a slow narrowing of opportunity. This is why debt at 100% of GDP doesn't feel like an emergency. It feels like pressure, constant, unrelenting, invisible at first. And it's why people sense something is off. Even when the headlines say everything is fine. The system keeps functioning, but it stops improving. And once that happens, the final question becomes unavoidable. How long can this continue before confidence, not markets, but people, begins to change? Because when confidence shifts at the household level, the effects ripple far beyond economics. And that's the last piece of this puzzle. Economic systems don't fail only because of numbers. They fail when people stop believing in the future those numbers promise. At high debt levels, the most dangerous shift isn't in markets. It's in expectations. When people believe effort will lead to progress, systems remain stable. When that belief erodes, stability follows. This is why debt becomes a generational issue. Young workers begin to question whether home ownership is realistic. Families delay having children. Entrepreneurs take fewer risks, not because opportunity disappears, but because uncertainty dominates planning. High debt doesn't just change government budgets. It reshapes behavior. People save more out of fear. They spend less on growth. They prioritize security over innovation. This is the paradox of heavy debt. The very policies meant to stabilize the system end up suppressing the dynamism that once fueled it. And slowly, the economy shifts from expansion to preservation. This is where confidence matters more than GDP figures. Because confidence isn't measured quarterly, it's lived daily. It shows up in housing demand, in career decisions, in whether people believe the system will reward patience and effort. Once that belief weakens, restoring it becomes incredibly difficult. This is why history shows prolonged stagnation at extreme debt levels. Not collapse, stagnation. A slow grind where growth exists, but feels inaccessible. And this is where the comparison to past empires becomes tempting. But comparisons miss the point. The United States doesn't need to collapse to lose momentum. It only needs to lose direction. Debt at 100% of GDP doesn't remove America's strengths. It narrows the margin for error. Mistakes become more costly. Shocks become harder to absorb. Recovery takes longer. The system becomes brittle, which is why this threshold matters so much. It's not a finish line, it's a warning light. One that signals the next decade will be defined less by opportunity and more by trade-offs. But here's the part that rarely gets discussed. High debt doesn't determine the outcome. It determines the constraints. What happens next depends on choices and awareness. And that brings us to the final question this moment forces us to ask. Not what the government will do, not what markets will do, but what individuals should understand in a system where the rules have quietly changed. When systems change, most people react too late. Not because they're careless, but because the change doesn't announce itself. High debt doesn't come with alarms, it comes with subtle shifts. The goal at this stage isn't to predict collapse, it's to recognize constraint. Because in constrained systems, the winners aren't the most aggressive. They're the most prepared. Understanding debt at this level changes how you interpret everything else. It changes how you see inflation headlines, interest rate decisions, housing affordability, even job security. You stop asking, is this temporary? And start asking, what direction is the system leaning? That shift alone puts you ahead of most people. In high debt environments, stability becomes valuable. Flexibility becomes strategic. Liquidity becomes optionality. This doesn't mean fear, it means awareness. People who thrive in these environments don't bet everything on a single outcome. They diversify not just investments, but assumptions. They understand that growth will likely be uneven, that volatility will return more often, that policy responses will be reactive, not proactive. And most importantly, they understand time horizons. Short-term noise becomes less important. Long-term positioning becomes everything. This is why education matters more than prediction. You don't need to know exactly what will break first. You need to understand why something eventually will. That knowledge changes behavior. It encourages resilience. It discourages overexposure. It rewards patience. And it reframes success. In a high-debt system, success isn't about chasing maximum returns. It's about avoiding unnecessary fragility, avoiding positions that only work if everything goes perfectly. Because at 100% debt to GDP, perfection is no longer the baseline. It's the exception. This is the mindset shift most people never make. They assume tomorrow will function like yesterday. But systems under pressure don't repeat. They adapt, sometimes smoothly, sometimes painfully, but always differently. Which brings us to the final truth of this moment. America hasn't failed. It's entered a new phase, one where consequences are delayed, not avoided, one where trade-offs replace free choices, one where understanding the system matters more than trusting it blindly. And that's why this moment deserves attention, not panic, attention. When you step back and look at the full picture, one thing becomes clear. America's debt didn't reach 100% of GDP because of incompetence. It reached it because the system chose stability today over consequences tomorrow. Again and again. And for a long time, that trade-off worked. Crises were softened, markets were protected, growth was extended, but every extension came with a price. And now that price has arrived in the form of constraint. This is what makes this moment so difficult to process. Nothing looks broken. Markets still open. Paychecks still clear. The dollar still trades. Yet beneath the surface, the system behaves differently. Policymakers react instead of lead. Markets become more sensitive. Households feel pressure without a clear cause. This is how high-debt environments operate. They don't announce a turning point. They reveal it slowly, through tighter financial conditions, through policy confusion, through growing disconnect between official optimism and lived experience. And this is why the question, what breaks first, matters. Because it forces us to stop thinking in absolutes. It's not about collapse versus survival. It's about friction versus momentum. High debt increases friction everywhere. It makes growth harder to generate, mistakes harder to reverse, trust harder to maintain. And while the United States still has immense advantages, innovation, resources, scale, those advantages now operate within tighter boundaries. The margin for error is thinner. That doesn't mean decline is inevitable. It means awareness is no longer optional. The people who struggle most in these environments are the ones who assume the old rules still apply, that growth will naturally lift all outcomes, that policy will always step in on time. that the future will resemble the past. But systems under pressure don't reward assumptions. They reward understanding. Understanding how debt reshapes incentives, how it changes risk, how it shifts power quietly, from choice to necessity. This is why moments like this deserve serious attention, not because they signal the end, but because they define the path. America at 100% debt to GDP isn't a headline, it's a condition, one that will influence decisions, markets, and lives for years to come. And the sooner that condition is understood, the fewer people will be surprised by what follows. History rarely ends with explosions. It ends with adjustments, quiet ones, the kind that only make sense in hindsight. When future generations look back at this period, they won't point to a single crisis and say, that's when it happened. They'll point to a shift, a moment when the rules subtly changed, when debt stopped being a tool and became a constraint. America reaching 100% debt to GDP will not be remembered as a collapse. It will be remembered as a transition, from expansion to management, from ambition to prioritization, from choice to trade-off. That's why this moment matters more than most headlines, because systems don't warn loudly when flexibility disappears. They simply respond differently. Markets become more volatile. Policy becomes more reactive. Growth becomes harder to sustain. And people are left wondering why effort doesn't seem to go as far as it used to. Not because the system is broken, but because it's under pressure. This is the part most discussions miss. Debt doesn't destroy nations. Complacency does. Nations survive high debt when they recognize it early, manage it honestly, and adapt expectations accordingly. They fail when they deny it, or assume yesterday's strategies will work tomorrow. The United States still has enormous strengths: innovation, scale, human capital, global influence. But at this level of debt, those strengths must work harder to produce the same results. Nothing is automatic anymore, and that's the real shift. Understanding this doesn't require fear. It requires clarity. Clarity about how incentives change, about why volatility becomes normal, about why stability feels more fragile, and most importantly, clarity about personal expectations, because the people who navigate high-debt systems best are not the loudest, they're the most informed. They understand that long-term thinking matters more than short-term noise, that resilience beats optimism, that awareness beats prediction. America has not reached the end of its story, but it has reached a chapter where consequences are no longer optional. They're delayed, and delayed consequences always arrive quietly before they arrive loudly. If this video helped you see the system more clearly, then you're already ahead of most people, because history doesn't reward those who react fastest. It rewards those who understand first. This is Histo Finance, and this is how the past explains the present, before the future makes it obvious.